For 40 years, the British property ladder had solid rungs. You left school, you saved, you climbed, and the system mostly worked. Today, those rungs are made of glass, and the ladder itself is floating 10 feet off the ground. And yet, in 2026, people are still climbing. Not because they earn dramatically more than everyone around them, not because they got lucky with an inheritance. They're climbing because they've quietly stopped playing the old game. They're using a completely different set of mathematical tools, and over the next 4 minutes, I'm going to hand you every single one of them. Let's get you off the ground. Step 1. Build the right deposit in the right place. Here's the trap almost everyone walks into. You open a standard savings account, you start putting money aside, and it feels productive. But that account is quietly working against you, because while your cash sits still, house prices keep moving. Think of it like the high jump. The house price is the bar. Every time you sprint toward it with a cash-only account, someone raises that bar another 3 inches. You run faster, you save harder, and the target lifts again. You end up exhausting yourself trying to clear a height that never stops rising. The Lifetime ISA is your springboard. Here's the cheat code. Inside a Lifetime ISA, you can pay in up to £4,000 each year, and the government adds a 25% bonus on top. That's a free £1,000 every single year, dropped straight onto your deposit. You can open one between the ages of 18 and 39 and keep collecting that bonus right up until you're 50. Now watch what happens with 2 people, a couple, each paying in the full £4,000 a year, each collecting their £1,000 bonus. Over 4 years, that's £32,000 of their own money, plus an instant £8,000 handed over by HMRC, a £40,000 deposit, and a fifth of it is a gift. This isn't your pension. It isn't your SIP, locked away until retirement. It's a springboard built for one job, launching you over the bar before your energy runs out. If you take one action after this video, open one. Step 2. Shape your income so the bank actually says yes. Every lender works behind a wall. It's called the multiplier, and the standard ceiling is 4.5 times your gross income. That's before tax and NI, not what lands in your account. That one number decides almost everything. A couple earning a combined £36,000 can borrow around £162,000 and not a penny more, no matter how badly they want the house. On a 5% 5-year fixed over 25 years, that's a repayment of around £950 a month. So your job isn't only to earn, it's to protect that multiplier, your credit score shield, and to clear away anything the bank counts against you. Get onto the electoral roll. Don't open new credit in the 6 months before you apply. Keep your balances low. And here's what nobody tells you. That £400 monthly PCP payment sitting against the car, the lender doesn't see £400. It sees an anchor, roughly £25,000 shaved straight off what they'll lend you. One shiny car on finance can quietly cost you an entire spare bedroom. Then there's the reality of the mortgage itself. Living with a 95% mortgage, a 95% LTV, at 5% interest is like living at high altitude. The financial air is thin, every bank rate decision, every unexpected bill, and you're gasping. So before you climb, you build an oxygen tank, an emergency fund of 3 to 6 months of essential outgoings. When the pressure drops, you keep breathing calmly while everyone around you panics. Step 3. Accept that there are 2 Britons. This is the one that changes lives. In London and the home counties, the average home now sits around £500,000. In parts of the North East and the Midlands, it's roughly £180,000. Same country, same currency, a completely different life. Run the multiplier, and it turns brutal. To clear the borrowing on that London home, a couple needs a joint income of around £100,000, with monthly repayments north of £2,600. In the North East, the same step onto the ladder needs closer to £36,000 of income and under £1,000 a month. One is mortgage imprisonment, the other is financial independence. And here's a detail that ambushes thousands of London buyers. Your LISA can only be used on a home, costing £450,000 or less. In the capital, the average property is already above that ceiling. The very tool designed to help you is locked out by the postcode. There's a moment, any quiet morning, the moment you refresh the property portal, when something shifts. You realize that moving 60 miles isn't running away. It's the single biggest lever you own. That's the moment you stop being a spectator of the market and become a participant in it. Step 4. Know your bridges. Not everyone can leap the full gap in one jump, and that's fine because there are bridges built for exactly this. Shared ownership lets you buy a slice of a property, say 25%, and pay rent on the rest, with the option to staircase and buy more over time. First home schemes offer new builds at a discount to local buyers. But be honest about the trade. Owning 25% means you're on the ladder, you're building a little equity, and you're shielded from rising rent on your share. It also means you don't fully control the asset. There are usually service charges, and selling later is more complex than a standard sale. Renting 100%, by contrast, keeps you flexible but builds you nothing. A bridge is not a trap, it's a bridge. The only mistake is treating it as your final home rather than a crossing to the next stage. Step 5, and the most important. The goal was never getting the keys, it's keeping them. Almost anyone can scrape together just enough to get through the front door. The people who stay are the ones who built a structural buffer, money set aside, roughly 1% of the property's value each year, for the repairs and life interruptions that always arrive. On a £180,000 home, that's around £1,800 a year, quietly waiting for the day you need it. Don't forget the friction on the way in either. Legal fees, surveys, searches, and, for anyone who isn't a first-time buyer, stamp duty. First-time buyers usually escape it on lower-priced homes, but the rest of those costs still stack up. Budget £3,000 to £5,000 on top of your deposit before you've hung a single picture. The buyers who forget this are the ones stretched to breaking point on day one. A margin of safety is what turns a homeowner into a secure homeowner. It's the difference between owning the house and the house owning you. One more thing, because it ambushes almost everyone, that 5% 5-year fix doesn't last forever. When it ends, you don't quietly carry on. You roll onto the lender's standard variable rate, which can sit several points higher, and your payment can jump overnight. Picture a repayment climbing from around £950 to well over £1,200, with no warning shot fired. The buyers who stay calm are the ones who saw the edge coming. 6 months before your fix runs out, you start shopping for the next deal, that's the remortgage, and you lock the new rate in early. You never let the old deal simply expire and drop you onto the most expensive rate in the building. On the ladder, the climb never fully stops. You just learn to plan each rung before your foot ever reaches it. So let's be clear about what the ladder actually is now. In 2026, getting onto the property ladder is no longer a rite of passage. It's a strategic operation. The deposit shield, the multiplier mastery, the geographic pivot, the bridges, the margin of safety, 5 tools, 1 plan. Wealth in this country no longer belongs to whoever chases the dream hardest. It belongs to the ones who stopped chasing and started executing. The bar is high, but now you've got a springboard. Go and clear it. If you learned something, make sure to like and subscribe. I'll see you in the next one.